All right, Dan here for a market call trade break-in. I want to look at the Nasdaq 100 through the QQQ, and I want to use options. I want to trade these things. There's two stocks that I'm focused on this week, and this may come as a big surprise. One of them is Tesla. The other one is Nvidia. Look at Tesla, how it gapped up on Friday. That was the day of the kind of cool jobs report here, and I think giving some investors a bit more confidence that the Fed is done. So what are they doing? They're going and buying some of the most expensive tech stocks there. Gave back both those gains, two trading days in a row. Here's a stock contending with that 200-day moving average. I think it's headed back towards that $200 level. I still think the fundamentals are poor here and not getting better anytime soon. The other one would be Nvidia. This company reports November 21st. Look at that downtrend that's been in place from those recent highs. Look at the bounce that it had off of those recent lows. Never got to its 200-day moving average, but up about 15%, double the performance of the Nasdaq 100 during those time period. I think these two stocks have the potential to lead the Nasdaq 100 to the downside here now that most of the others have their earnings out. Let's look at the QQQ chart. It looks very similar to that Nvidia chart, but this one did bounce off its 200-day moving average. It did bounce off that technical level at around 340, which was the breakout from early May. So I want to use options to define my risk. Why? Look at the price of options, implied volatility in the QQQ. They ran up pretty aggressively into earnings period. Now that we have Apple pretty much out of the way, which is most of the Mag 7, again, we just have Nvidia in a couple weeks here. Look at how the price of options in the QQQ has come in really hard. Plot that against historical vol, how much basically the ETF has been moving around, and you see that implied vol has come in well below that of historical, also leading to me to believe that option prices are cheap. So here's the trade. I want to look at December expiration. I want to use a put spread. I want to buy one of the December 365 puts at about 6.25. That's when the stock, the ETF, was trading around 369 today. And I want to sell one of the 340 puts in December at about 2.25. My max risk is the $4 I'm paying. It breaks even down about 2% at 361. I have gains up to $21 between 361 and 340 with a max gain of 21 below 340. But I suspect, it's going to find some good support down there. So again, I am risking 1.25% for possibly 5.5% gains between now and December expiration, or on December expiration if the QQQ is down about 7.5% or so. I like the risk reward here. I like the technical setup here. And I also think we're a bit overdone on the exuberance in the rally since the Fed meeting. So check us out for more of these on our YouTube Risk Reversal Media page there. Obviously, you can follow us on the Instagram at Risk Reversal Media. I am Dan S. Nathan on the Instagram, and we'll put this on the Twitter. So stay tuned for more of our break-ins on Market Call.